On April 29, 2026, the financial world watched a high-stakes experiment aimed at solving a massive constraint in the capital markets. The architect of this offering was Bill Ackman. Since 2004, his firm, Pershing Square, has generated cumulative net returns of over 2,600%. Over that same period, the S&P 500 gained roughly 836%. But Ackman's firm operated as a traditional open-ended hedge fund. That structure carries a glaring vulnerability. During 7 market panics, investors can aggressively withdraw their capital, forcing the manager to sell off holdings at the worst possible time. To escape this cycle of redemptions, Ackman set his sights on a completely different model. He wanted to build a permanent capital platform, operating exactly like Warren Buffett's Berkshire Hathaway. Making that transition required a mechanical shift. Ackman needed to launch a closed-end public fund, a vehicle where the invested capital is locked in and cannot be redeemed by panicked investors. To achieve permanent scale, Pershing Square had to convince the public markets to hand over billions of dollars and agree to never ask for it back. The problem is, closed-end funds suffer from a well-known mathematical glitch called the closed-end fund discount. Look at this animated scale. On one side, you have a fund holding $100 worth of liquid corporate stocks. On the open market, you'd expect the fund's ticker to also be worth $100. Instead, it mysteriously trades for significantly less, say $70. Pershing Square already knew this pain. Their existing European closed-end fund traded at a severe 29% discount to the value of its underlying assets. Despite this structural flaw, Ackman attempted to push through a massive new U.S. vehicle in early 2024, aiming to raise an astonishing $25 billion. The roadshow quickly hit a wall. Institutional investors simply refused to pay $50 a share at the IPO, knowing the price would likely drop the moment it started trading due to that built-in discount. Ackman abruptly canceled the offering. The market had made its terms clear. Investors demanded a mechanical safeguard against the discount, meaning Pershing Square had to completely engineer a new kind of IPO. To fix the structural flaw, the firm spent 2025 laying down a new foundation. The first step was establishing a verifiable private market value for the parent management company itself. They sold a 10% minority stake to a group of strategic investors. This transaction officially valued Pershing Square Capital Management at roughly $10.5 billion. Next came the legal restructuring. The firm converted into a Nevada corporation and created a special voting share. This share holds no economic value, but it legally guaranteed that Ackman and his team would retain absolute control over the firm's investments. All of this set the stage for the 2026 combined offering. Instead of just listing a new fund, Pershing Square designed a highly complex transaction to simultaneously list the new fund, ticker PSUS, and its parent management company, ticker PS. By attaching a $10 billion valuation to the management company in the private market, Ackman had manufactured a highly valuable asset. Now he could use it as a powerful incentive for public investors. Here is how that incentive worked. The core mechanism is a 1-to-5 distribution ratio. For every 5 shares of the new fund purchased, you received 1 management company share for free. A $250 investment yields your fund shares, plus an immediate $24 bonus. The new fund also offered highly attractive operational economics. It carried a flat 2% management fee and, crucially, 0 performance fees. The structure also created a specific cross-fund synergy. Under the new agreement, 20% of the management fee revenue from the new U.S. fund is redirected to offset the high fees paid by investors in the older European fund. On paper, this multi-entity structure was a perfectly engineered $5 billion machine. It addressed the discount risk and aligned the financial interests of every global stakeholder on the platform. On Wednesday, April 29, 2026, the 2 tickers debuted on the New York Stock Exchange. The broader stock market was strong that day, with the S&P 500 hovering near record highs. But the reality of secondary trading hit hard. The meticulously engineered PSUS dropped 18% on day 1, crashing from its $50 IPO price to an opening price of $42. Part of the crash was driven by retail mechanics. Small-scale investors, buying in through platforms like Robinhood, either flipped the stock for quick fractional gains or panicked and sold at the first sign of red. The rest of the crash was driven by institutional arbitrage. Sophisticated Wall Street firms refused to pay $50 for the new fund, when they could buy the exact same portfolio by purchasing the older European fund at a massive 27% discount. The mathematical engineering behind the sweetener simply could not override the psychological panic of retail sellers and the ruthless arbitrage algorithms of institutional traders. Leadership immediately went into damage control. Bill Ackman hosted a live broadcast on X Spaces, transparently addressing the plunging price and the retail selling pressure. To prove his conviction, Ackman stepped into the open market and personally purchased $40 million worth of shares, establishing a hard floor for the price. Despite the opening day volatility, the $5 billion raise achieved its primary objective. Pershing Square successfully locked 96% of its total assets into permanent capital vehicles. They absorbed a chaotic hit to their day one valuation, but the firm survived the public market crucible. Today, Pershing Square is officially positioned with the scale and stability to operate as a modern Berkshire Hathaway.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.